Hello, everyone. Welcome to Currency Exchange, a NatWest podcast series all about foreign exchange markets. I'm Brian Daingerfield. I co-head G10FX strategy here in the U.S. at NatWest. And I'll be your host today. And once again, I'm happy to be joined by Paul Robson, who co-heads G10FX strategy with me over in London to talk about all things global markets. We have tariff de-escalation. We have a very busy UK data schedule that took place in the week gone by. So, Paul, thanks very much for joining.
Well, as always, thanks very much for the invitation. It sort of feels like markets are going up a hill and then coming down again and going back up a hill. It's certainly interesting times for markets.
Yeah, I do want to start in the UK. As I mentioned at the offset, this was a very busy week. And I mean, as we record on Thursday morning, I just look at my Bloomberg calendar and I see maybe 15, 20 different lines of big economic data releases in the UK. It feels like, sterling's being driven by some of the more global drivers. We'll touch on in a second. But I did want to ask to get into some of the specifics of this UK data. What are you seeing here and how's that impacting your views?
Yeah, so as you said, it was a very packed UK data calendar of important releases. I think most clearly the labour market data. We think that's going to be the key driver of the policy response for the Bank of England. So definitely worth just delving into that in a little bit more detail. We also had quarterly GDP numbers, which were important because the UK's growth performance in recent years and the outlook, to be honest, hasn't been that great. So I think it was interesting to get that update. For me, the key takeaway was that in both those sets of releases, there was very little support for the idea that the Bank of England should loosen more quickly. And loosening more quickly definitely seems to be, certainly in London, the consensus view, either because people think that the data are softening and the Bank of England needs to be more forward-looking in their views, and ultimately they will get to that, or they think that it's a bit of a policy mistake that if you don't tighten quick enough, you end up having to ultimately loosen more quickly. So these data didn't really support that. Let's get rates lower more quickly. In terms of the actual data, it was actually a good first quarter from the UK. I can't remember when I said that last. So we had 0.7% growth on the quarter. Maybe pre-COVID it wouldn't have been that great, but it means the UK is probably the best performing economy in the G7, which I think is welcome news. The details were a little bit hard to sort of square maybe with other views. So we had a really very strong investment performance in the UK. One of the themes in the UK has been persistently weak investment, and it all seems to have come in the first quarter. Business investment very strong. Maybe it was just one-off investments that were moving the needle. Net trade exports were pretty good, but I think that might be front loading of exports ahead of some tariff worries that you just mentioned in your opening comments. It is the first estimate, and it's mainly based on output, not expenditure, so it can still be revised, but let's see over the months ahead. But I think another key message from that particular release is that it's probably the high watermark, we think, in terms of growth for the rest of the year. It gets a bit more challenging from here. We've obviously got tariffs again. It seems like we spend the whole time talking about tariffs. We've still got tightening monetary conditions for households through remortgaging. We've got the impact on employment from the national insurance contribution, changes minimum wage. So from here it gets a little bit harder for the UK economy. On the labour market, it's also interesting because the data covered that key pivot point for the national insurance contribution change and the expected impact on employment between March and April. And it feels like just as growth is peaking in the first quarter, this might be the worst news on employment. We still think employment drifts lower, but maybe the sort of month-to-month gains don't get any worse from here. But if you take all that together, the economy still generates quite a lot of domestic inflation, and ultimately that's what the Bank of England is going to be focusing on.
So how are you thinking about this in the context of the Bank of England's, what markets are pricing for the Bank of England? Because it seems like, you sort of maybe gave it away at the top, noting some of the stronger data. But, we have seen markets have pulled back a little bit in terms of expectations for BOE easing this year. Does that jive with how you're thinking about the market here and what the balance of risks are around the Bank of England's policy rate?
Yeah, very much. I mean, you said that the markets have moved a little bit. They've actually moved quite a long way. It started with the monetary policy report and the Bank of England, where there were those two surprise votes for unchanged rates. So markets have been reacting to that. You've got this better than expected data, I think, on the margin. As I say, not a lot of support for quicker monetary policy loosening. And also you've got the international backdrop. De-escalation is, I'm sure you're going to be delving into that in a little bit more detail in a moment. But it's very hard to now sort of disagree with market pricing. Not often you can say that. So markets have got 45 basis points of easing by the end of the year. They've got 57 over the year. That compares to our economics team's base case of 50 basis point cuts by the end of the year, and then they're done at 375. And that essentially that's what markets have got. So in terms of the Bank of England, markets are looking relatively fair. Whether the market actually, the consensus outside of interest rate futures is still more dovish, and that can still play out, but much more sensibly priced, I would say.
Now, how are you seeing this offer the currency? I mean, as I see here today, I know that euro sterling has come off of its sort of post-Liberation Day extremes, if you will. It's had a nice run here against the euro. How are you thinking about sterling as we take the sort of totality of the data and how the pricing has moved in the UK for the Bank of England as we think about sterling here?
Yeah, it's interesting you mentioned euro sterling. I mean, I do think that Liberation Day sort of move and the initial tariff shock dislocated markets. Euro sterling rallied really quite hard on not a lot of fundamental differences between the euro area and the UK. And I think it's right that it's come down. That was our expectation. I still think the risks are biased lower in euro sterling. But I think that sterling is very much beholden by what's going on in the US, if I'm honest. I don't think there's a very strong Pacific sterling story. We can have the cautious cutting Bank of England relative to a more sort of lower rates in the euro area. That I think that's still a theme, and hence why euro sterling goes lower. But my main focus, as we've been talking about the last couple of weeks, is this idea of capital outflows from the States, if it does in fact happen. And if it does happen, where could it go? And crucially, into what asset? And I still think that at the margin, that's just helping sterling a little bit in terms of maybe FX reserve diversification, maybe retained earnings, maybe hedging of portfolio holdings in the US, something that you've talked about a lot, about under hedging, which I think has been crucially important. So pretty balanced here, I think, but marginally positive against European currencies, and watching that data in the US and what the dollar does and tariffs. And maybe that's a nice segue into shifting it over stateside. So we obviously had the news events on Sunday. De-escalation feels like it was at the sort of top end of expectations, beating expectations. But I'm interested to know how you saw it, and how do you think it matters for the dollar?
Yeah, I saw it exactly that way, as a de-escalation that was above and beyond maybe even the most optimistic of expectations. So you compare what the president tweeted on Friday before the weekend talks, which was an 80% level for effective tariff rates on China. It seems a level that's about right. What we got at the end of the weekend was a de-escalation that pushed the effective tariff rate somewhere in the mid 20% range when you consider that tech was already excluded from the tariff. So you have 20% fentanyl tariffs and a removal of all of the reciprocal tariff regime to push China tariffs to the minimum 10%. So that gets you a 30% additional tariff from the entire new Trump regime, which is reduced in effective terms because tech is excluded from those. There's also small differences in terms of how the sectoral tariffs lean, but in general, the 80% level that Trump threw out on Friday was well above where we've ended up settling with this de-escalation move. And the response in markets has been substantial. And one of those has been a stronger dollar. And I think part of this is positioning, where if you look at the speculative positioning data, for example, some of those that we watch were showing that dollar shorts were getting to levels that were last seen in late September of last year when the Fed was contemplating and ultimately delivered a 50 basis point rate cut, for example. So I think position was part of this, that markets were not expecting, certainly myself, I was not expecting this scale of de-escalation. And so what I think markets have done is they've clipped some of these downside tail risks from the U.S. economy. If the fear heading into and through the Liberation Day period was that the Trump administration was willing to push growth into a lower steady state in order to achieve a massive change in the U.S. economic relationship with its trading partners, we've now pulled away from that extreme. And so growth expectations have been moved up and inflation expectations have been moved down. So we've sort of priced away from this sort of extreme stagflationary environment. And you've seen it come through in a pressuring of the sort of sell America positions. There's probably a limit to how much further this can go, however, just based on tariff de-escalations. Because you think about where we were on April 8th, just before the tariff de-escalations were, the first tariff de-escalations were announced post-Liberation Day, and where we are today, almost everything that was announced has been delayed, with the exception of two really big major, you could call it three big policy changes. The first is the 10% universal minimum tariff bill in place. The second is the sectoral tariffs. And then the third is fentanyl-related tariffs. These are border-related tariffs that affect China and then also Canada and Mexico. So you think about where is the additional de-escalation going to come from? The UK trade agreement, which we talked about last week, Paul, one of the features of that was that even without a meaningful trade deficit with the UK, they were unable or unwilling to reduce the tariff level on imported autos from the UK below that 10% level, even though they allowed for a tariff rate quota system to allow some to come in under a lower tariff rate. So the 10% universal minimum tariff, it appears that the administration is unwilling to negotiate below that level. Additionally, on the sectoral tariffs, what the UK agreement maybe suggests is that there's less willingness to negotiate away fully the sectoral tariffs and maybe adjust those along the margins. So that leaves the fentanyl-related tariffs as the final piece of potential de-escalation, if you assume, as I have, that those other ones will not necessarily be able to be negotiated away. So what I think all of this means is that from a de-escalation standpoint, we may be at the peak of what markets should reasonably expect, that additional de-escalatory steps from the US from here may be fewer and further between. Now, that's not to say that we didn't get to this de-escalatory point quicker than most expected, quicker than I expected, but I do think we should consider whether or not we're at a peak in terms of how much further trade de-escalation we can get. I do think for markets, it's important that maybe this issue can potentially move to the sidelines a little bit here, that now that the most extreme tariff escalation has been delayed 90 days at least, potentially indefinitely, if you believe, I think that's the general market consensus, that maybe these issues can move to the sidelines a little bit as a day-to-day, week-to-week, minute-to-minute driver of currency policy, of currency markets. And I think what you've seen is a decline in cross-market volatility as a factor here, whether that be if you look at the VIX in the equity market or in some measures of FX volatility as well. And Paul, you mentioned relative monetary policy as a potential driver in the UK versus Europe as one of these drivers. One of the things we've seen in the dollar is a breakdown in the relationship between front-end interest rates and the dollar broadly. And I think one of the reasons for that was exactly what you mentioned, which is this foreign flow story about this idea that the US is maybe more sensitive to the specifics of performance of the equity market, making it almost trade like a risk-sensitive currency, even though we know it tends to be a global safe haven. But also this higher volatility environment may be minimizing or reducing the importance of the specifics of front-end carry as a reflection of dollar valuations. And so one of the things I think we'll have to watch closely here is, does a lower volatility environment lead to maybe some reassertion of those past relationships where the hawkish Fed, and we still don't expect in our baseline for the Fed to be easing at all this year, that's something that I think if you see a reconnection of that relationship could mean that the dollar does maybe a little bit better here. So I think you take all that together and say there was some reason, and I think it's right to say that the dollar has pulled back a bit here, and that the shift in growth expectations has reduced the likelihood of significant downside tail risk, and so reduced some of those extreme dollar negative types of scenarios. But I don't think the dollar is out of the woods here by any means. I still think those medium-term questions about dollar exceptionalism, we still think growth is going to settle in the mid-ones in the U.S. next year. So these questions for the dollar, I think, are still very much out there, although I think it's right that this de-escalation was more than expected, and that's led to a pullback in some of these positions.
Yeah, very interesting. And this idea of sort of peak de-escalation certainly seems to be on people's minds across asset this week. There were also some headlines very specific about the dollar's role in any sort of trade agreements, to what extent. I think you mentioned last week about trying to get the dollar down while keeping a strong dollar policy. I'm not quite sure if we can solve for that, but that was definitely some of the headlines. So what did you make of those headlines that seem to be tying the sort of dollar weakness to some kind of trade deal for various economies?
Yeah, this is certainly something that I think it's right that markets are thinking about this, speculating about this. And I think it's only natural because the Trump administration, they want lower bilateral trade deficits. And there's multiple ways you can sort of approach this problem. You could call it a problem, right? In the eyes of the administration, it's absolutely a problem. In other senses, maybe not so much. But one of the ways that you can approach this is by tariffs, because tariffs almost by default, when you increase tariffs in the US and you have them reduced in foreign economies, then that creates changes in the relative value of imports versus exports, and it can reduce these bilateral trade deficits. Currency is another way that you can reduce bilateral trade deficits by changing the relative price of these imports versus exports. And so I think it's only natural for markets to think that the currency could play a role if the end goal is to reduce trade deficits. But I continue to generally think that it's unlikely that we're going to get specific currency commitments within trade agreements. Now, the UK wasn't a great template here because we don't have these issues of persistent FX interventions as an issue between our two economies. But certainly this is something that for Asian currencies in particular at emerging markets, China obviously, but also some of the other Asian Asia economies, this is something that I think very much features in the economic relationship between the U.S. And those nations. And I think markets are looking at whether those nations are maybe more tolerant of FX strength against the dollar during this sensitive negotiation period. But I still think it's unlikely that we're going to get some sort of enforceable FX target, some sort of large multilateral style agreements to weaken the dollar on a cyclical basis. I think, as you mentioned, Paul, it's inconsistent with a strong dollar policy, which is really encouraging investors, foreign investors, to invest in the U.S. A shift in the cyclical dollar policy effectively encourages or it discourages that investment because it basically asks them to maybe pull back a little bit in terms of their holdings of U.S. assets in order to encourage strength of their local currencies. Additionally, I mean, if we look at previous engagements by the Trump administration on currency, think about phase one. Now, this was during the first Trump administration, the phase one deal between the U.S. and China. There was currency language within that deal, but it was very, very similar to what we have seen in past agreements that, as part of IMF commitments, G7, G20 commitments. For years now, those have talked about that nations will avoid FX interventions to manipulate their currencies for competitive advantage. And even the phase one agreement that was, inked with China in late 2019, early 2020, effectively included this language that the Trump administration's desire for China in this phase one deal, which took multiple years to negotiate, largely stuck to the script in terms of FX commitments that are already in place. Now, these commitments are not enforceable, generally speaking, certainly the international ones. Even the bilateral commitments are maybe difficult to enforce. But we don't think that the administration is pursuing specific FX targets as part of these discussions. We think that's unlikely. Instead, we think that the commitments within those agreements are likely to follow the traditional language, which is that nations are prohibited from or discouraged from intervening in FX markets for competitive advantage purposes. So if they keep to that status quo rather than something specific on currency, that's not to say that the markets are going to be any more sensitive or any less sensitive to this idea of the Trump administration. Part of their goals is to reduce these trade deficits, and currency weakness of the dollar could be a part of that. I don't think that gets rid of that speculation, but we don't think that we are looking ahead to some sort of imminent change in the way that the administration and its foreign counterparts are actively discussing short-term policy on foreign exchange. So, Paul, we've gone a long way. We've jumped all around across the Atlantic here, talking about some of the drivers in the UK and, of course, globally with the trade policies and in the US. So I think we should call it here. Paul, thanks very much for joining. As always, great chat. And to our listeners, thanks very much for joining this week's pod. If you liked this episode, consider giving it a like and also subscribing to the channel so that you get our latest podcasts once they're released. Thank you very much.